Some discussions may touch on legal and tax topics, but nothing contained in these episodes should be considered tax or legal advice. David and I are not accountants nor licensed attorneys. Please consult with your tax and legal professionals for advice on your own unique situations.
Welcome to Did It Close? I'm David Dirkschneider, joined as always with Brian McCann. Our guest today ran a hedge fund, and in 2009, while most investors were losing everything, he hit an all-time high and then walked away from it to build one of the more disciplined multifamily platforms to invest in Oklahoma. We've done business together for years. I've got a lot of respect for how he thinks. Bruce Fraser of Elkhorn Capital Partners. Bruce, welcome to our show.
Thanks, David. I didn't even have to pay you to say all that. That's great. David and I have known each other for a long time. Yeah.
Yeah. Best money ever spent. So Bruce, I'll jump right in and I want to start kind of before Elkhorn, before the hedge fund, and really before any of it. You grew up in Dallas, where you're still at. And you mentioned that your grandfather was one of the most formative financial influences on your life. And even though you didn't experience it directly in your household, he was the only doctor in a small town. In fact, I think you said he owned the hospital, and over the decades quietly built thousands of acres of timberland land and mineral rights underneath it. Can you describe what it was like watching that, and then describe kind of what happened and when that discipline didn't follow through to your father?
Yeah, and that's the unfortunate part, of course. But he was my dad was one of 5 children, and he was kind of at the latter end of that. And so I don't think he got quite as much hand holding as the earlier ones probably did. But my grandfather was, I wish me today could talk to him, because I was much younger when he passed, and had not hit college or anything yet. It was prior to that. And so I'm kind of sad that wasn't able to occur, because just even being a young guy, I saw what he had done, and it was amazing. And he's the type of, like you said, he was the only doctor in a small town for a while. And ultimately the town grew a little bit, and there were more doctors, and they were all kind of under his wing. The hospital was actually called Fraser Hospital.
That's cool.
And ultimately ended up being a Fraser East and a Fraser West as the town grew. There were 2 different hospitals. They owned them both. But,
wow.
But small town doctors sometimes, people they can't pay the bill, or, but they've got some land or they got some animals or something. And so over time, and he bought a lot of it as well, but over time, I know that he did become a pretty large landowner, and all of it was producing returns in some form or fashion. And, it stuck with me. He was really formative or very instrumental in the formation of Toledo Bend, the lake. And he owned a lot of the land that actually got covered up. But he was smart enough to retain the mineral rights to that. And gosh, he's been gone for a long time, but I would say, I don't know, maybe 10 years ago or something, my dad got a phone call out of the blue. It was Chesapeake or somebody. And, they still he owned a percentage of a whole section of land underneath Toledo Bend, which happens to be one of the largest natural gas deposits in the country, I think. And so he was very wise and benefited, for a long time. Some of his smart actions. So, yeah, I was just gonna say, seeing that early, I think it did have an influence on me, because I just, he wasn't. He was a great doctor, I think, but I think he was a really good person as well. I remember being taken aback at his funeral. There were grown men crying at his funeral that I had never even met, and so they certainly weren't family or anything. It was just people in town, and they were just sad for the loss to the town.
How old were you when he passed away?
I don't know, David. I think I was in high school, if I remember right.
Yeah.
And I was not the mature, savvy investor I was now. I was pretty wild back then, so I wasn't paying attention to much business at the time. We weren't having business conversations back then.
Makes sense. Right.
But yeah, I guess, we talked about my dad briefly too. And he was, and I don't want to go too deep into personal stuff, but he was not financially savvy. And, if he made $1, he spent 2, and he never really planned or saved and things like that. And, I never felt like I had someone I could financially fall back on. my grandfather was no longer around, and I didn't feel I could fall back on my family, and so it just really made me risk averse. That coupled with having a really strong minded uh, CFO at home, losses are not allowed, and so it's just not allowed, and you can't go backwards. In fact, my views on inflation. We may get into some of it, but one of the other investments I'm in and have been in heavily for a couple of years now are long call options on gold and gold miners and silver miners. And I made the mistake. Gold has pulled back a little bit here. It's still I think has a pretty good move left in it. But I logged on at the high one morning, and it was the absolute peak of I made the mistake of telling you the account balance, and so now unless I'm above that, it's inexcusable. Yeah, so I gotta get back.
Yeah, you just can't mention the peaks anymore. So
yeah, no, learn a lesson.
So you mentioned that, talking about kind of with your dad, just not just that, but the kind of not anything to fall back on. And you also mentioned before to us that you had to pay your own way through college. And you never talked about having that, like I said, to anybody to fall back on. So how early in your life did you understand that? And how did that shape the way you think about risk now?
Yeah, I mean, I remember it was time to start applying to colleges, and my dad literally asked me, he's like, well, how are you going to pay for it? I was like, oh, okay. So, that's kind of where that conversation went. And fortunately, I was able to get some grants and student loans, and that affected the first handful of years of being married because we couldn't go on vacations or go out to dinner much or anything like that because all my extra money, bonuses, and I'm just going and paying off those loans. So I'm thankful to have been able to receive when we go to school. I'm not complaining, but that's just kind of how the cards were dealt. But it does, when you don't have a lot, every dollar counts. And, that's why I really, having that background early on, I just have a very low tolerance for risk. And once we dig into what we actually do at Elkhorn, I don't know if all the listeners will agree with that, but I'll explain my rationale on why we do what we do and how we do it once we get there. But very risk averse, and options sound crazy and risky too, but I do options so that I can put a lot less capital at risk and get the same upside as somebody that puts a lot more at risk. And so it's actually because of that.
And we're happy to jump into. You don't have to wait for anything. Yeah. And so I think that's one of the things that I've always been most fascinated with you is just the not necessarily just the risk averse, but obviously that's a good one, for anybody that's an investor, but just the thought process that you've always put behind your investments and the level of detail that you put in all your analysis.
Yeah, and I guess I'm just wired that way from an early age. I remember I probably outgrew Money Magazine when I was 13, something like that. And I started reading, much more technical stuff and about trading and other ways. And I was kind of fascinated by the stock market because it seemed like there might be ways to build a better mousetrap, and you could create wealth rapidly there. There's no time component to it if you got good at it. And so I just really dug in and started studying it. Like I said, I ran a hedge fund for a decade. It was an options-based hedge fund, but it's what's called an absolute return strategy, which means you try to make a steady return no matter what's going on in the world. And that's very hard to do. And, we, as you mentioned, we were at our all-time highs at troughs of 2009 in the public markets, but that did not come without stress. I mean, delivering that to investors, this nice steady return stream was very stressful to do. And so you're paying attention to all the data. The fund back then was a net seller of option premium, which means, we always hedged it, but you had asymmetrical risk. You could make $1, but you could lose 5 or 10. And so our win rate on our trades was fluctuated between 92 and 94%, but that other 6 or 8% could create big losses. And so, yeah. And one of the terms, it's probably not PC, but me, I'm not that PC focused,
right.
But something as we call planes and building risk. You don't know when you're going to wake up one day and the world's going to be different. And, nobody had 9/11 on their bingo card, I don't think, or at least my crew didn't. But, going into that day, you guys might remember, but the stock market didn't open for a week. And when it did, it was down sharply. And so the fortunate thing is, went into that morning and as a portfolio manager, or someone that's managing money for other people, if you take that fiduciary position seriously, and sometimes you have to act in ways that other people aren't acting. Like when I first saw that news, I immediately logged on and tried to put on trades, and it's my responsibility to do that. I couldn't just sit there and stare at the TV all day, but the market never opened, so we had what we had, and we had a single digit drawdown because we knew exactly what our risk was when we went into it. So and we still oversee a bunch of money in the public markets. I know, David, you know that we between the real estate and the public markets, we oversee about $1 billion. But they're all quantitative approaches. I think that our real estate is a much more quantitatively focused than most other operators or owners. And to us, like I said, that's just how I've been wired. I want to analyze everything, and I want to see why I'm in the trade. And I think that a lot of people that did multifamily didn't know why they were in the trade. They just flipped some houses and went bigger, or they'd gone to a conference, or, hey, everybody's getting rich over here, I want to go over there. And so, I had someone at an offsite with about 15 or 20 operators pull me aside, because I don't post a lot, but when I do post, I post on LinkedIn, and it's macroeconomic content.
Usually good.
Well, thank you. But try to dumb it down so it's big and not talk too geeky, but it's often not super optimistic, and I kind of get bad rap for that, but it's just the data. It's just like the government debt's out of control, and it just is what it is. It's mathematically not solvable. But this guy asked me, he's like, well, you told me that multifamily is a great inflation hedge. I'm getting hammered. I'm like, well, if you were in it as for an inflation hedge, you should have fixed as many costs as you can, for multiple years. You went floating rate debt to make the deal work. And then you bought in a market where there's tons of supply coming online, so you have no pricing power to increase your revenue. Like, you got it absolutely backwards, and I think, to me, it's totally predictable that people are struggling in Houston and Atlanta because so much supply is coming on. It's just, you can't fight that. If you can go rent a brand new building, then you're going to, if it's for the same price. And so the other people have to lower the rents. Same thing, Austin. Love the city. It's town. It's a lot of fun to visit. They have great food, lots of good restaurants, but the affordability of what people spend as a percent of their income in Austin was way above the national average. And you have all these new owners coming in saying, "Oh, we can just raise rents." Like, no, you can't just raise rents, because people can't afford it. And the national average is 30%. I mean, David, we just bought 4 distressed deals in December, and after we bring them back online, clean them up, increase rents significantly, we'll be at 22 to 26% of the median income in the 2-mile radius of each of those properties. It's still super affordable even after we do it. And to me, it's just math. You just look at it, and I think, to me, we let the math lead us certain places. And that's, people ask me a lot of the time, like, why are you in Oklahoma? Like, look at the data. I had a lender ask me that in Tulsa, because they had never loaned in Tulsa. Had breakfast with him one day because I wanted to meet him in person. And he asked me that. He's like, why do you even like Tulsa? And I started just listing all the data of, all the population growth, the affordability, that supply had actually contracted in the city space. And, that allowed us to, at the time, we were getting double-digit rent growth. And then I started naming markets that I would never buy in, at least based on the current data. And he kind of started laughing. I'm like, what? And I said, do you like those markets? He's like, no, we have deals in every one of those markets you just named that are struggling. Like, why? Like, maybe you should look at the data. Yeah.
Bruce, you hit on something. You hit on like many things actually that I'd love to dive into. One of the things that you said, I actually like, and I find it interesting, is you talked about the stress. And I know this is kind of like off the technical side, and I think like some people underappreciate that, and just like, how did you manage that, like, more on a personal level? I was like, people like don't necessarily understand sometimes the chronic stress in businesses where there's like a lot of volatility. Can you give us any insights on that, and just kind of any strategies you had around that?
How do I handle it? Tequila is very helpful. The good stuff, though. But I don't know. I don't think I handle it very well. Part of it is, myself and my right-hand guys in both these businesses, we take it very seriously, managing other people's money. And, I would take a 0 before I would let an LP's return be impaired. And that's just how we're wired. But that comes with a burden as well. I mean, everybody that's an investor wants their investor or their investor manager to have that frame of mind, but it does wear on you over time a lot. I mean, going through the financial crisis, that was crazy. And the stress that created, trying to figure out what was going on and how to position for it. But, I think that investors really appreciate people that take that mentality, but also can deliver results. It's very hard to find I think it's hard to find a combination of people that are very trustworthy and you can trust with your capital and that are good at making money. And so I think that's why, our repeat investors are so high. I mean, we have over 100 repeat investors that a lot of them invested in, a dozen deals with us. And, they don't even look at the deals. It's just a scramble to subscribe usually when we send it out. And so, because I mean, if the guy's made you money 10 other deals that are similar to this, you figure, you probably don't need a backseat drive. Probably got it down. And, one thing that I don't think I've ever told him how meaningful it was to me, but we've got an investor. He's been with me since the early years. Really nice guy. Actually lives pretty close to me over here, but he's very hands off and he very rarely asks questions or anything like that. But I hadn't talked to him at the time in a year or two. And just out of the blue, I get an email from him that said, "Thank you so much for everything you've done for my family. It made such a financial impact on our lives." I was like, well, that's really cool. Because a lot of people forget to say thank you. It's just when something goes wrong, you complain. And we definitely have one or two of those too, but thankfully more of A than B.
I mean, what you're doing makes a big impact on people's lives. So that's good to hear that.
I honestly always feel anxious at this point. I've done it for so long that I'm trying to find ways to deal with that. Golf is not the answer. I don't think. I thought it would be, but it just adds a whole nother layer of issues. And, but just having fun, spending time with the family really is the best solution.
I gotta ask is when you're 13 and 14 and reading Money Magazine and then more technical stuff, what are the people around you say? Did you always know you were destined for this?
Well, I now they say, "What's your minimum?" But, at the time, I mean, I was a very early Amazon customer back, nobody remembers this, but they used to only sell books.
Yeah.
And the only way I could get the content that I needed or wanted, no sane bookstore would ever stock it because they've a handful of clients in the whole country that give a shit. And so, I had to order my books from Amazon to get them. And so that's why I was such an early Amazon customer. I remember actually even getting a gift from them. I think it was it wasn't Yeti at the time because Yeti didn't exist yet, but it was something like Yeti. And they thank us for being early customers. But I don't know. Like I said, I was in kind of a financially unstable environment, and I felt like it was going to be on me to figure out a way to get out of that. And so just started learning as much as I could. Like I said, I thought there was probably a better mousetrap, and I think we've definitely created some of those because. Like I said, we still oversee quant strategies in the public markets, and they've done great. I mean, highly risk managed, as you might guess, but 5-star rated. We have a leverage strategy that's more volatile but still risk managed. And I think there's something called eVestment. It's a database. It's ranked number one in global quant strategies. Oh, wow. I probably shouldn't be talking about that. I can't talk about the company name now because I'm not supposed to talk about securities, but it's also, I learned a lot early on, and I don't know, I felt like even when I was super poor, because my wife and I started off, in the whole, I remember there was a mutual fund company that would allow me to add $25 or $50 at a time, and the market would dip, and I would add $25 or $50, which is comical now, but that's how it got going.
Well,
and then in grad school, I'll add to that a little bit. I felt like to achieve what I wanted to achieve, I thought I would need an MBA. And so I went to grad school. I wasn't a super focused student undergrad. I met my wife, and I spent a lot of time not in class, but again, it was good grounding because eco-finance background undergrad, but the grad school is where I really started focusing. And I had two different profs. One was a derivatives prof, and it was his thesis that, listen, you don't need to know all the tools. You just get good at, one or two of the tools and you can do well. And so one of the things we had to do for that class, as well as the other one that was really influential, was you had to design a strategy and trade it throughout the term, not, on paper. And your returns and results were part of your grade. And so, that makes it real. And I guess ever since that time to now, I've always been graded on performance, basically. You live and die by your numbers. I've created nice wealth for my family, but I did it by making other people money and just getting a portion of it, which is a good feeling. Not selling them widgets they don't want.
So was that from the professor when you were getting your MBA? Because I know you mentioned one of the adjunct professors, a man that ran a large institutional fund, was influential in your career. Is that who you were just mentioning, or
It's actually not. He was a different guy. That
the Wall Street?
I guess. Yeah, he ran the largest international fund in the country at the time, and for whatever reason, spent time in Dallas with students, and he shared a lot of knowledge with me. We had a similar project in that class, and to me, I've never been a stock picker. I don't know that. Certainly these days, there's no efficiency in that at all. You got Anthropic and things like that can help shorten the curve. But I always was more prone to numbers-based or quantitative approaches. And so in that class, I developed a strategy that ranked, it started with a universe of 100 stocks, but I won't give away all the secret sauce, but there's a predefined universe set by another company that they had already filtered companies for a certain category. And then I took that and ranked them based on some different momentum factors and other things like that. And it actually was a separate hedge fund that I ran for a while, but I remember in a time when the S&P was down, I think it was like 9% over this period. This multi-year period. That fund was up almost 600% net of 2 and 20. And so, and its genesis was in this guy's class. But one of the things, having a scoreboard that counts towards your life does add some of that anxiety and stress, but it also makes it real. You have to focus because the real impacts forthcoming from it, and whether that's your grade or whether you get a big bonus or not because of the performance. And so, the thing is, most of my early investors, I knew them. I knew their families. I knew their kids. And that makes it real. Like, hey, I'm either going to pay for this kid's college or I'm going to make it where his dad can't afford to go to college. And hopefully nobody ever gave us all their money, but there is a reality to the impact that you're having on people's lives.
It's interesting. It's a good way to look at it. One thing I find interesting and kind of transition to real estate is, you're managing a hedge fund, doing the research, and, realize basically something was broken, right? And then rather than just kind of repositioning the fund, you liquidated everything, all of it, right? And then that's when you got into real estate?
No, not exactly. Now, I did feel like, I'm not going to say I predicted 08. I didn't know how bad it was going to get, but I knew it was too good in 07. There's something called the VIX, which is the volatility index. That's, normally averages, 14 or something like that. It got down to single digits. It was like 6 or 7, unheard of low vol. And I remember there's a guy that moved on, not my street now, but at my fort where we used to live. And it's a nice area, but I remember he ran a high yield fund. And we were at a block party. I was talking to him because talking shop, and I was like, well, how are you guys allocating now? Because you're not getting paid for the higher risk spread. And he's like, oh, we have to allocate money. I was like, okay, I've seen that movie. That's not going to play out well. And the next year, he didn't live on our block anymore. And so it's a true story. But so we, just looking at the data, not getting paid for the premium that we should have been for the option premium risk that we saw, we backed way off of our positions, and we're monitoring things really closely, fully hedged. And so we didn't bet big that the market was going to go down, even though I did have a bet with another advisor. I'm like, S&P is going to break 700. And he's like, no way. I'm like, it's just the math. You take where earnings are going to be, how much that normally pulls back in a recession period, and throw at times kind of a bottoming multiple. I'm like, it's below 700. And, went to 666. And so, being an absolute return fund, I couldn't bet big on something like that happening, because if I was wrong, I would lose a bunch of money. But I did bet a little. And so, we not only paid for our fee, but we were up a little bit when a lot of people were down 50, 60%. And when you do that for somebody, people notice. And then people started asking me, can you take my kid's trust? Can you take this? And like the regulators, people always say hedge funds are highly unregulated. That is not true. Being an investment advisor is one of the highest regulated businesses you can be in, and it's not fun. But I started doing what's called separately managed accounts, which this was about the time Bernie was getting perked to walk with his Yankees cap on, nonstop. You listen to what he said he was doing. It was options related. And here I am, this small fund. I'm doing options like, it's, I don't know. Like people ask questions. And so I felt like if I was an investor, what would I want? at the same time, technology was really shifting, and I could trade 100 accounts or 1,000 accounts just as easily as I could run the fund. And because you do what's called a block trade, it gets the full execution. And once that's fully executed, it averages the price, and everybody gets the average price. So everybody gets the same fill. So technology was moving that way. And I just felt like if I was an investor, I don't want to have to depend on a auditor or something to tell me the money's there because they may be on the take. I want to be able to log in and see it. And so a lot of these big retail names like Fidelity, Schwab, there are a bunch of them out there, but have an institutional arm too. A lot of people don't know that. And so we custody a significant amount of money at Schwab and Fidelity that are held in other people's names, ton of different accounts, but they've hired us to be their hired gun. And so we still oversee around 700 million in the public markets using some of these quant strategies. Now, it's not the ones that I used to use. These are something that a lot heavier risk managed, but still same focus. You try to make the dollar or the number go up. Don't get back. Try to make a 5, don't get back, or try to make $1, put it in the pile, but don't get back a 5. It's kind of how we think about it. But so I didn't liquidate everything, but what I did do is I liquidated the real estate investments that I had, and not our personal home, but I was doing some investing with one other individual that I knew from the corporate world early days, and based on the research I was doing for the fund, we decided, we're going to sell all of the real estate that we have because real estate's going lower. And then I formed Elkhorn in 2010 and started back at it. And that was largely due to my macroeconomic views because, with the GFC, the Great Financial Crisis, knew the Fed was going to have to print a ton of money to kind of work the way out of that. And that's highly inflationary to basis the currency. And so that translated to me. And it's obvious that you wanted hard assets, real estate being one of them. And I felt like multifamily had the best risk reward of everything that I contemplated.
Why was that? I hear you. Go ahead, Brian.
Yeah. Why was multifamily? I would just be curious.
Yeah. So if you look at the big categories, retail and office, I had no idea the paradigm shift was coming in office. But I just didn't like that they were both so business cyclical. And, I felt like I don't want to be moving up and down with performance just because of the tide. And so I felt like residential made more sense to me. And, I did some SFRs early on just because I didn't have the capital or the investors yet. But, I knew that after some of that stuff went well, and, this was a couple years post the financial crisis, banks started lending again, then, I wanted just to buy some stuff and own it. I didn't want to be on the debt side anymore because we were doing some hard money lending and things like that in the early days. But where you can make a nice high interest rate, but it doesn't protect you from a massive spike in inflation. And so I wanted the asset itself, not the paper. And I think a lot of people are getting wrong right now. We'll see how it plays out. But a lot of guys have spun up these distressed debt funds or just debt funds in general. And man, I wouldn't touch the paper side of it. I'm glad lenders like it, but the inflation helps protect them and make their assets or their loans safer because they're only looking at a nominal basis, not a net basis, a real basis, net of inflation. So that's why I got there. That's how I like it. And ultimately, we got to where we are now because we do distressed situations. David knows some of the stuff we bought, but I've said this publicly a lot, but you buy something broken and fix anything at all, it's going to be worth it. It's pretty clear. And so, all the guys are out there chasing these pretty assets. I can't figure out how they make money with them unless they get cap rate compression. And, the assets we buy are a lot of work, a ton of work to turn it around and get those results, but usually have just really significant equity improvement within the first 12 to 18 months.
Yeah. And I hear you say that phrase all the time, probably more than anybody, about just the I'm blanking on the hard assets, right? Being in hard assets right now, just and the hedge against inflation is a big part of your investment thesis.
Big part, yeah. And that's why I'm in these markets, like I said, because the affordability is so low or so good, and it just works. Like we were positioned all in fixed rate debt coming into the rate hikes of a couple of years ago because of my inflation views. I'm like, if they're going to borrow money, let me borrow money at 3%. I'm going to take it for sure, but I'm going to lock it in. And a lot of people kind of doubled their pain because they were bidding on deals lots of call for offer deals. You're kind of bidding against yourself blindly in those cases. And then the only way to make it quote work was to get a little bit lower interest rate. And so they would floating. And a lot of the people had interest rate caps, but those expire usually 2 to 3 years. And so that timing didn't work out for a lot of people, as you both know. But I don't know, we were 100% fixed rate debt going into it. And then it just, we had a couple that we had been planning to sell. I think, David, you were about to help us with one of them. And, the market just got, the transaction volume just seized up. And so we're like, well, I guess we won't sell this year or next year, but we'll just start distributions instead, because we're making money on the properties even without selling them, like I said. And so a lot of people are losing assets left and right, or entire portfolios in some cases. And we started, I think January of last year, we started distributions on 6 properties. So
that was also, I think, around the time, 3 years ago, that same timing when you decided to, when you're going to hold on to things, when Elkhorn made the decision to bring property management fully in-house, right? I remember talking to you about it a bunch of times, and it was a big decision for you.
It was a big decision.
Yeah.
It was a very big.
Why'd you make that move? And,
Matt made me. No, he was on that, beating that drum for a long time. That's my right hand guy here. But, we just felt like we were having trouble finding confident people and that would follow through on things. We would want to set comp plans for managers to drive certain behavior results, and they would just forget to tell them stuff like that. And it just, during the COVID lockdown, we literally had he was the director of the property management company, tell us, you remember this, they had CARES Act money. And so literally, if people weren't able to pay, all you had to do is file paperwork, and you would ultimately get the money. It's government, so it takes a while, but you would get reimbursed for the rents. There's a whole program around that. We had a property that had over 6 figures of rents due to us, and he just didn't file paperwork. He's like, we missed the expiration on that. My bad. I'm like, what? I mean, I'm like, I'll give you the 10, and then I'm starting shooting. Run.
Yeah.
And so you're dealing with stuff like that. It's just super frustrating, because there are things that they're supposed to be doing that they don't, and impacts our investors. And so we did it just to have control. We are known as good operators in the markets, I believe, and David, hopefully you believe that.
Yeah.
But so with that, people see the results and they come to us, and we've had a couple thousand doors offered to us third party. Hey, we manage these assets. The answer is no. I mean, we're not going to do it for other people. It's a completely different business. And it could put our reputation at risk, because the property may need something and they don't give us the money, and so the results aren't what they could be. Plus, it's just I'd rather buy the asset, make millions, than
get a fee.
Again, then clip a fee. Yeah, it's just not compelling to me. And plus, my CFO at home told me I wasn't allowed to. So you can't have another business. So yeah, it seems surreal. But yeah, we've got 60 employees, and Chris, here in the corporate headquarters, it's just a handful of us, but because the teams are out at the properties, but that's a big responsibility too.
We mentioned it on the panel. You were recently on a panel that we had, the Oklahoma Multifamily Symposium. It was a owner developer panel, and we talked about that. Management they get, if they do a great job, it's the owner that did a great job. I'm talking about third party, and and if they don't do a good job, it's the management company's fault. And so I've always said third party management is high risk, low reward, and it's just it's a different.
I think
business.
So. It is a business where all the stuff lives that people don't want to deal with in real estate. Like everybody's like, oh, I don't want to get a call when the toilet clogs up and all that. But at the same time, that's you look at some of these assets, $10-20 million asset, and you've got someone making 50-60 grand that's in charge of it and its results. And so it just doesn't make sense. And if they don't care about their job because they're not treated right or they're not paid well, then it shows in the results, and it could cost us millions of dollars. And so we approached it. You don't usually, and David, you've heard me say a lot of these things probably, but you don't usually find someone coming out of grad school or B school and saying, hey, I want to get in property management. That doesn't happen. And so
luggage. I mean, you got rejected from that.
Yeah. So I think, we have a really good team, and we kind of threw our team at that problem. We've gotten some different results than other people do. And, I think that the mindset is expense management in a lot of cases. And we're really not, we certainly could want to control expenses, but we pay our managers kind of market comp on their base, but then they could make 50% more, double what they could make anywhere else with the incentive comp that we put in there. And, if we pay them an extra 30 grand a year or something, let's say in bonuses, we probably made millions of dollars. And so people lose sight of the impact of that. You drop 100 grand in the bottom line, throw a cap rate on it, that's, 1.6, 1.7 million that you've created, whether it was from expense or driving revenue. And, we saw it firsthand, because one of the things we incent is, we switched, instead of vacancy or occupancy, to economic occupancy, where they're focused on managing, not just having someone in the unit, because they may not be paying you, but collecting. And then also, occupancy that we do, we tiered it. So most of the companies will pay you if you hit 90, but that other 10% is a lot of margin. And so we have it go all the way up. And so, our properties that were running 90, 92 went to 98, almost overnight.
It's amazing what incentive does.
Yeah. Yeah. And then you also have this employee that doesn't want to lose their job, and they want to drive results, because that's how they're making all the extra money. And they know if they lose their job, they're not going to be able to make the same money. So it's just a much better model, I feel.
I've always been blown away at owners that have a 10, 20, even $50 million property, and they're so focused on hiring someone at the lowest possible rate, when if you had a 10, 20, $50 million business, you would make sure that you had a qualified and competent CEO, and a manager is the CEO of that property.
Absolutely. Yeah. 100%. And then, thanking them and telling them they're doing a good job when they are. People want to be appreciated, and that is a hard job, being a site manager, because you can't be friends, but you have to be friendly, and it's tough. And we know it's
workforce housing.
Especially workforce housing. Yeah, you've got some real characters in some of these properties.
Bruce, question for you. Like, you've been involved now in a number of industries that, I think some people actually take shots at too, right? So you can say, like, people will say, like, hey, a hedge fund manager will never outperform like an indices in the market. So I guess my advice is, or my question is, what advice, besides give it to Elkhorn, when people are looking to somebody like, as like a money manager or somebody to invest with, what should they be looking for? Like, what are the distinguishing characteristics in your mind that make, for somebody that's good, that's somebody that's poor, or maybe something that somebody could question a little bit more?
Yeah, that's a tough question. That's a good question. I think the masses out there, I think the common saying is they spend more time planning their vacation than they do their retirement, and so a lot of people just don't think about it, and that has allowed an industry where there are a lot of schmoes. A lot of guys that just add no value. They're just feeding off of the accumulated assets and collecting a fee, not actually driving any performance results. And so, in that industry where we always have to say past performance is no indication of future, bullshit. I know that's the regulatory thing of what we have to say. I think that if you put a scoreboard by any of these talking heads on CNBC, when they interview them, nobody would listen, because so many of these guys just don't do well, but they get on TV, they replay it on their, Twitter feed or whatever. And a lot of people give them money, and not because they're good, just because they saw them and they trust that they wouldn't be there otherwise. And that's just not true. I think that performance is really important. I would ask them, what do they do differently? Because 95% of the advisory firms out there, they just have this kind of spiel about allocation and overweight this, underweight that. I don't want to be underweight something if I don't like it. I don't want to own it. Period. Zero allocation, not underweight it. And most of those guys are just trying to match S&P or maybe beat by a point or two. There's so many better ways to do it. And, we have people, even large investment firms, like we have one firm that our strategies are tactical, meaning they adjust to the changing market, kind of get in and out of things in that world. And, some people just want to own long-term. And like, sometimes that's not a good idea. And I look at two different scenarios that come to mind. One is, I used to read this technical analysis writer, and she still had a screenshot of her quotron, which is how you used to get quotes, on the October of 87 day. And, it was of the Dow 30. And you look at the Dow 30 and think, oh, those have been around forever. I don't even recognize some of the names on that list. Things change. And you need an investment manager that can adjust to that, and most don't. But we know, because we act as, in that business, we act as a sub-advisor for a lot of other advisors that are just kind of relationship people, but they don't really know how to manage the money. And so they allocate to us to manage the money for them. So I would definitely look at performance. The other interesting thing that most investors don't know is licensing varies dramatically. There's you walk into a Morgan Stanley, a Merrill Lynch, even Fidelity and Schwab, the people there are FINRA registered. That means they're held to what's called a suitability standard. That means that they are allowed to recommend anything to you that is suitable for your risk profile, even if one of those options pays them 7% out of your money up front. That's allowable in that world. Separate world, and where most independent advisors play, is we're held to what's called a fiduciary standard. And so we have to act in investors' best interest to the best of our ability. We would lose our license or be massively fined or something if we did the same thing. And I think that's really important. So that would be a starting filter for me. And you can't just ask them, are you fiduciary? Because a lot of people that are on the other side still call themselves fiduciaries, but they aren't technically by licensing.
Is that allowed, or is that technically illegal to say that?
Yeah, a lot of technically illegal things happen in that side of the world. And so, yeah, it's, or should be, and so, yeah, that'd be my first question. How are you licensed, and are you licensed as a fiduciary? So that, and then look at the results and what do they do differently? That was kind of long-winded, but that's
how are you really different? Good information.
It's like, like when you're interviewing somebody, like, why are you the right candidate? And don't be afraid to ask that. Why are you different than that 95%? And we have answers for that, but I think a lot of advisors might have to do a little something else.
If you can, I mean, like if somebody asks you that question, what makes you different? If this is the right forum for it, if it's not totally understand.
Yeah, I don't want to get too deep into that stuff because they're just the regulatory world's so crazy. And but
and you don't want to give the competition your pitch.
No, I don't. So we're not talking about any specific securities or products, but in general, I think, obviously, from my background and my personal stuff I share, risk management is critical because most investors don't have the stomach to tolerate an 08, and inevitably they're going to sell at the wrong time because their guy's going to be telling them, "Oh, just hold through the downturn. A good quality stock. It's going to come back. It always does." Blah blah blah. But you know what? It was 15 years before the NASDAQ made a new high, and everybody's celebrating, "Oh, the NASDAQ made a new high." That tells me it went 15 years making nothing.
Yeah,
15 years. I couldn't tolerate 15 years of that. So I think a strategy that allows you to get to the sidelines when appropriate should always be utilized in my mind. And a lot of people don't do that. Most people do not do that. And the reason is they're
masses,
not,
right?
Yeah. And it's because they're not using quantitative solutions that are telling them, they're just emotional about it. And some people will get it right, just being emotional and kind of guessing where things are going. But the data will tell you if you look at it. And there's just most investment advisors don't.
Do you think that, I'd be curious on your opinion on this. Do you think that we're in a situation where we'll have more black swan events, and I use that term loosely, going forward than we have in the past, or they're going to accelerate it more? Just because the world's just moving so much faster nowadays with everything that we see. I'm just kind of wondering what your thoughts are.
I think so. I think there will be periods of low volatility, but there's potential for massive events and massive risk all over the place. Look at what's going on in private credit right now. It's a complete disaster. We know firsthand, we had two different lenders bring deals to us in that they were bridge fund groups or something, private funds that were lending on bridge, where they said we could literally have the asset as long as we bought it at unpaid balance. We don't have to bring equity. They're going to have low interest rate. They even offered a lower interest rate elsewhere on other loans we had. And we couldn't do the deal because we looked at it and went, I'm not sure we can get to that value in 5 years. In 5 years, I don't see it being that valuable. And so they're way underwater. And I think that's just two of dozens and dozens of companies out there that have massive damage that is not being shown yet. And we've seen a couple of private credit funds just the last week or two throw up what they call gates, which means investors are asking for redemptions and they just say, no, you can't have your money back because they're not liquid and they can't sell stuff at the values that they haven't marketed. So I think there's going to be a lot of, coming to the music, so to speak, here shortly. I think within the next 12 months on that. What that does throughout the financial markets, who knows, but it's not going to be positive. And I think that the speed at which information flows now, I think you're right. We could be on X and see a video of a bomb that went off an hour ago, right? And or if less, if not real time. And that didn't used to exist. And I think a great example of it was Silicon Valley Bank. You guys saw that blow up and how quickly that occurred. That bank run occurred in a day or two. Used to, that would have been over weeks and months, but it was because all you have to do is grab your phone, open the app, wire the money, gone. And so they had fairly predictable, again, how that would happen with that bank because they had a really concentrated depositor base. So the private equity firms had hundreds of millions of dollars with them in some cases, and you lose that account, leaves a mark. And it's not thousands of people have 10 grand, 20 grand in there. Their deposit base was very different, and they made the mistake of chasing yield like a lot of people do. They had to make something on their money, so they bought longer term mortgage-backed securities. Well, we know how that went. When rates spiked, those things became worth 50% probably of what they were before, and because the longer duration is on the loan, the more impactful rate changes to its value. And these guys had gone 10 years plus, and you have a 5% move down in rates, and that could impair you at least 50%. So did absolutely the wrong thing. They shouldn't have done it. The Fed, I don't know. I don't know what they're doing on their audits, but certainly not anything they should have for risk management.
So I want to shift a little bit and we'll get back to it, but I wanted to shift a moment to something that had a big impact in your life because I know it still impacts it, right? And how you handled it. So in June of 24, you were in London with your wife, right? She collapsed. Yeah. Your exact words is she looked dead. I mean, and ultimately was diagnosed with long COVID and spent 500 days housebound, which until this happened, I mean, because I talk to you pretty regularly, I had never even heard of long COVID and couldn't stand for more than 30 minutes at a time. You've said all the time, you're a girl dad, have two daughters, you run this firm that we've talked about, very successful, $1 billion or more for families that you take very personal and managing that money. So, how do you describe, the 0% capacity that you had and, what did that look like?
It looked terrible. And it wasn't 30 minutes at a time. It was 30 minutes in aggregate a day. She went from walking 6 miles a day, taking care of the family, going to the grocery store, cooking dinner. She loves to cook, walking the dogs, and to that. And so it was completely debilitating. Most people haven't heard of it, like you said. I thought COVID was no big deal. I thought that's not even hardly a cold anymore. And then this happened. And it affects kind of certain categories of people a lot worse than others, but I won't get into all that. But yeah, it's hard to even find doctors that know how to treat this because they're still trying to figure it out. But we have a couple very, very brilliant people that we've been working with, and we feel like she turned the corner September, October, but there's a long road back because it did a lot of damage to her body, and so we're trying to do some procedures and things to fix it. None of it's insured, of course, because insurance companies, they're like, there's not a pill that you can take to solve this, and so you have to kind of experiment with a bunch of different things because everybody's different. But so it's been certainly a negative financial impact, but fortunately we had the means to do it. And what's sad, we've had multiple doctors tell us that people without means are not getting well from this because they can't seek the specialty treatments that we have had access to. And there were some really dark periods, and I'm just thankful and blessed that she has turned the corner because we've come across a lot of people that are 3, 4, 5 years in and still suffering. And so,
and you might explain what long COVID is, because like I said, I had to research it, and my guess is most people don't know what it is.
Yeah. So whether from contracting the disease or from the vaccine, it could be caused either way. Your body starts creating what's called a spike protein, and the spike protein creates these what they call microclots. They're not technically blood clots, or the kind of protein cluster things, but it's a small clot that's kind of protected by some kind of protein shell, and so they're very hard to get rid of. And those things kind of bang around in your blood vessels throughout your body, and depending where they do damage, it can cause 30 different probably or more symptoms. And some people sleep all the time, some people can't sleep at all. It affects people differently. So, but chronic fatigue, like just completely debilitating fatigue. Insomnia. It was my wife. She had a sensory sensitivity, like she had had a severe concussion. So even though she's by herself, she couldn't talk on the phone to friends. She couldn't read a book. She couldn't watch TV. And so just desperately lonely. For whatever reason, my voice never bothered her, so I could talk to her for a long time. But everybody else, including our kids, even when they were home, sometimes it would just wear her out. And so, yeah, it's really tough. And anyway, I think we were kind of put through all of that so that we would know how bad it was and try to find some of these solutions, because we do have the means. And our plan is to form a foundation and raise money from people that we know. Once she's able to kind of stand up in front of a group and talk about it, and then go help some of these people that don't have the money. There's a kid in one of her kind of groups that she's in that, I think he's 25 years old, and he used to be a long distance runner, and now he can't sit up for more than, I think she said 2 minutes at a time. And so, just devastating. And, I think if I remember correctly, he's 5 years into this. So some of the treatments, would we pay for him? For sure. We need the umbrella of the foundation for liability and stuff. Paying for treatments if something went wrong, you'd have to, they could come after you even though you're helping them. Yeah. So, well, having these businesses, I have a lot of counsel. Even though things go well, you make sure they keep going well because you get good attorneys around you. So.
Which speaking of business and dealing with long COVID, I think one of the, I guess, I don't want to say good outcomes, because there's not a good outcome with that, but one of the things you noticed was the team that you had built around you really had to step up, didn't they? And
they really did. And you asked me about my capacity for stress and everything, Brian, and I had zero slack capacity for stress. You walk in, you see your wife, she's suffering, it feels terrible. I just felt like I was going to have a heart attack at any second. And so, bad things would happen. And fortunately, Matt would filter almost everything from me that he could, unless it was a, bigger decision on something. And them stepping up, it was super meaningful. And, we ended up having the best financial year ever of both businesses somehow. I don't know how that happened, but they're both growing and doing well, and you have good people around you. And it really showed. Because, if I had been a W-2 worker or things were kind of chaotic, it would have been a disaster. And if I'd had floating rate debt and I was having to deal with that on top of all this, oh my gosh, I don't know if I would have made it.
Bruce, can you dive into that a little bit about, how did you, and I know I love leadership topics. I love kind of go into that, but how did you surround yourself with good people? Like what was like, and that started many, many years before, obviously, the incident happened when you moved them. So,
Yeah, I would love to take credit for that, but my right-hand guy in both businesses, they both pushed themselves on me. So I got lucky, and I do think that your character is critical for me, and we take other people's money so seriously. I want somebody that takes it just as seriously, and then being bright and honestly, I think Matt comes up with ideas still that are just I hadn't thought of, or it's thinking about ways to improve. He's had some great ideas. We have a scale now in Oklahoma that why are we third partying all the make readies? And we hired a team of 5 people, and they're just floaters, and they do make readies and small CapEx jobs or small construction jobs. The big stuff we still outsource to a general contractor that's practically part of our team now. I guess we worked with him for years. If something goes wrong, he always makes it right. But we still spend millions with him every year. But that should cut our price in half on, let's say washer dryer installation. I cut it from $1,300 to $650. And we're getting $100 rent increases, $150 rent increases just for having the connections. Well, you do the ROI on that. Like, that's insane. And so, we just bought a portfolio of 500 units. Let's say all of them didn't have washer dryer connections. Some of them do, so it's not really fair. But just even at 500 units, I do the math. I hate doing math in public. You're a finance guy. I'm like, yeah, I know. It's on myself.
So calculator for.
Yeah, 500 times $100 a unit times 12 months, right? 600 grand and added NOI because all that's dropping to the bottom line. Put I don't know, 6.5 cap on that. You created $9.2 million in value just from doing that, and so clear path to money. That's why I love workforce. I don't love the work of workforce overseeing it, but there are a lot of broken properties and a lot of ways to create real substantive value versus, adding a pickleball court or something. I don't know.
And it's needed.
Yeah. Yeah, it is. It is. And it definitely is. And, we tend to, when we take over a property, a lot of work starts going on and start improving. And in most cases, the exterior in some way. People see that. And, workforce housing has a lot of ownership issues and a lot of management issues. And, lots of times they don't take care of the properties. And so they see that activity going on and us investing in the asset. And we tend to have occupancy flock to us because wow, they're probably going to do my work order if they're going to repaint the building, And so I think it's kind of self-fulfilling. Yeah. But yeah, I'm very thankful for the guys that were here and them taking on what they wanted to. Matt had been wanting to take on more responsibility. I'm like, here you go.
And they've done a great job. I mean, I know them all as well. And you do have an incredible team.
Yeah, I feel like we do.
And I know, go ahead.
I'm sorry, just one quick question because there's about a million more questions I could ask you because I think I find it as a really fascinating conversation. I'd be curious on your thoughts on, you talk a lot about workforce housing, and we're kind of at this inflection point where we have a housing crisis in a lot of places. Like, do you see any, what do you see as the horizon looking like when it comes to that in housing in America in general? And I know that's a very big and loaded question. So
Yeah, I mean, and I would have a better answer for that probably a few years ago, but with the progress of AI, it really clouds the crystal ball a little bit. How is that going to impact things? I can say I don't think I would want to own Class A personally because AI is going to have a disproportionate impact on white collar jobs. I believe that. Now, does it mean we're going to have massive layoffs? I don't know. It's possible. It's not a zero probability, but at least in our case with our business, I don't see us letting go of anybody. It would be, they can now do more and we can solve more problems. And so I think the people that do embrace AI early on, and I tell you, Matt and AJ, the gang here, they spend a lot of the day in AI doing different things. I mean, we had to look at marketing of one of our websites for one of our properties. It not only looked at the website, it searched Yelp and all these different places. And it's like, oh, wait, your phone number's wrong on this particular site. Like, we would have never caught that. Just simple things like that, it can help you with. So I think it's going to be impactful. I feel inflation can have an adverse impact more so on those at the bottom rung, because they don't have financial assets to offset it. They don't have portfolios of real estate or long call options on gold miners and things like I do to help mitigate those risks. But that's a risk that they can mitigate on their own. If inflation is squeezing them, they'll just have a cousin move in with them or something like that. So that's a solvable problem. Whereas, if there's really high unemployment, I think that that's hard to solve. And so most of our tenants are laborers. They use their hands. It's a job that, I don't know, maybe someday could be replaced by robots, but the cost benefit of that is so far out that I don't anticipate that anytime soon. So I feel like we're still we think about it a lot and we talk about it a lot, but I think that I still like where we are in the space. I tell you, I would not want office. I know office is already beaten up, but that's going to be a whole nother wave hitting office. I would short the office market if I could.
And this, I guess, and I think this is a great segue as we look into it. Is you kind of look backwards. If you could go back and give advice to your younger self, and maybe it's around it, like get as knowledgeable as you can on how to use AI. But I mean, what advice would you give to your kind of like your 20 or 25-year-old self if you can kind of go back there?
Well, a few years later than that, but I was at the hedge fund. The only position I had in the fund during when it just snowballed in 2009 were S&P puts, long S&P puts. And that's something that benefits and price appreciation from a decrease in the underlying security. And so it was small, but that's the only position I had. I would go back and tell myself, when you take that trade off, because I took it off a day and a half before the lows, buy a ton of leaps, long dated call options, and just leave them. And I would not be working for sure. I guess, I mean, honestly, I don't have to be working now, but that would have been like the best trade ever. I was on vacation with the family and, paying attention to them. And so even I was saying, you know what, we're at 600 in the 600s. I'll buy the S&P at 550. I started making bets for that. So I made some, but not a lot. But earlier, I don't know, get into multifamily sooner. I look at the wealth that we've created for both ourselves and others. And boy, I would have liked to have done that 10 years prior, 20 years prior. Because I mean, we're fortunate in our financial position now, but it would have been nice to be that way when the kids were younger, and be able to do more for them in an earlier age. Of course, they might have ruined them. I don't know, but I think there has to be a balance no matter what you have of what you give, because I've seen a lot of rich kids that are worthless.
Unfortunately.
Yeah. They don't work hard. I
Bruce,
don't know. Did that answer your question?
Absolutely.
Maybe be sure and talk to the girl in the library on this day when you go. I met my wife in the library at SMU, and it was probably one of 2 days I was in the library that year, and this was undergrad. So,
Things are meant to be.
Yeah. So,
there's about 1,000 more things I think we could dive into, but we want to be respectful of your time here. And we usually wrap it up with a little lightning round with a couple rapid fire questions. So I'll hit you off as best book that you could read, business or otherwise. What would you suggest to people?
gosh, I like spy novels and things like that for fun, but for business, I've heard a lot of people talk about it now. It used to be fairly esoteric, but The Creature from Jekyll Island. It's about the formation of the Fed and how it all went down. Because most people hear the Federal Reserve and they think it's federal and a reserve. It's not federal and it's not a reserve. It's a private entity that was formed by the bankers, and it had immense control. But it was designed to backstop with taxpayer money their losses. I mean, you go back a long time ago, the board at the bank was financially liable for anything that went sideways. They took that away. Everything went to hell. And JP Morgan himself and a group of other bankers snuck out of town and went to a place called Jekyll Island for this private meeting and came up with this whole albatross of a thing. And so that's interesting. It makes you think about the world differently in a big way on the financial front. And then I read one that was a little bit dark, but it was, God, what's the name of it? It was a diary of you could do diary during the Depression, and there was an attorney that literally kept a diary day by day. It was not an entry every day, but what was going on, what was being said by the government, what was where the prices of different commodities and stocks were, and kind of how everything fell out and who got hurt and who did okay. And the saying's the same: leverage can benefit, but it also kills. And pretty much anybody that had much debt was wiped out.
What was the first one? Jekyll Island?
Yeah, the Creature from Jekyll Island.
The Creature. Okay.
Those are two I have not heard before, and they're going on my list. So
Okay.
I appreciate that. My Audible subscription will get filled up this month. So
Yeah, hopefully they're on there. Maybe it's like the early days of Amazon. Like not many people sell it, so I don't know.
What's my questions? What's on your? You say your iPod, but it's not anymore. What's on your playlist?
Bunch of geeky stuff.
Music-wise.
Music-wise. Chris Stapleton, and I love some of the good country singers. Zach, I know, is a little unpopular now because of how he was treating his girlfriend or something. Something went down, but I still like his music. So I like those guys. Some old. I'm really, I was in high school in the '80s, and so I like a lot of music from that era as well.
I like Chris Stapleton, that kind of music too.
Yeah, I like a lot of the '60s stuff too, around wartime and around Vietnam War. There were a lot of good artists at that time.
Yeah.
All right, I'm going to go completely off script on this one, but you mentioned golf during it because I think you took up golf probably to relax like me, and I find it not relaxing. But you get to play 5 courses, and these are the last 5 rounds of golf. Where would you play?
3 of them I'm a member of, and so we have a place in Colorado, and it's just gorgeous. And the courses there, they have 3 courses and a short course, and the courses are gorgeous. So that would honestly probably be 3 of them. I just love playing them. Maybe, I don't know the name of course, but something cool in Cabo that's kind of out. I've heard about or seen pictures where they have some like greens that are like out on something that juts up, something cool like that. Gosh, I don't know. I'm not wound up in like the hype of the name of it. I just want it to be something really pretty. cool weather where you're not sweating to death and with some friends, And so I told myself when I started playing golf, and I was fortunate, it's actually one of my daughter's boyfriend's dad I was talking to, and he hadn't started playing until he was in his 50s. I was like, wow, maybe there's hope for me. And so, because I had never played, I was always too busy with everything. I just never took the time to take a whole day. And then the kids are young. It's hard to be gone for one of the 2 days. And it's too much burden to put on your spouse too, in my opinion. And so I didn't play till later. But I went to his guy, his coach, and I showed up for the first lesson, and he's like, okay, well, what are we working on? I'm like, how do I hold the club? He's like, okay. Okay. So we're starting there. And so, and it just progressed. And I was playing for about 3 years and starting to, I'd always told myself I didn't want to get too competitive about it, like business, because, option trading, I'm either ripping your face off or you're ripping mine off. And I didn't want it to be like that. I wanted to be good enough where people didn't laugh and point. They wouldn't mind playing with me, but I didn't mind going through some balls. If I shank it or something, I'll just drop a ball and hit it again. And I wanted to stay like that, but I wanted this thing with my wife made it such that I couldn't play for 2 years. After only been playing for 3, to take 2 off was detrimental to my game. Yeah. And so I got to play a few rounds last summer when we were in Colorado, but I couldn't really be gone for too long. But the last round, my buddy that I one of the guys I'm good friends with up there, he's like, I think that's the last game, the worst game you've ever played with me. I'm like, oh God. No. So I don't want this summer to be like last summer. I'm starting lessons again, and I'm going weekly to try to get my game back, clean it up a little bit so I can have some fun this summer. So golf, hopefully, I joke about it because it's just a frustrating game if you play, and that's why I don't want to be too focused on score. At first, I was just counting how many balls I lost, and that was kind of how I kept score, because my eyes are terrible too. But so I think that, I hope that that'll still be a happy thing for me.
Yeah, I took mine up COVID too. So I appreciate, I took it up later in life, and it's like, I took it up during COVID to get outside. But
yeah. So, well, it was kind of forced too. My wife's like, you've got to do something out of the house. Get out of here. Just go find something.
Well, there's hope for me because I still haven't taken it up. I play once a year for a charity scramble, only if we could use somebody else's ball.
And I missed out on so many business opportunities and things by not playing over the years. So that would be something else I'd tell my younger self, get out and swing a club.
I agree with that. One last question is, and this is interest rates, not Fed rate. Up or down this year?
Naturally, they would be up, but I think the Fed and Treasury will intervene, and so I think it caught the Fed off guard a little bit because they thought they had this a great power. Let me say that. That they could always control where things went with their rates, and then they moved their dial, and as you know, borrowing rates actually went up, and they went up for a reason. U.S. government is over 38 trillion of debt, and David, I write about this stuff a lot, but that's a lot of money. And when you even compare a trillion to a billion, it's stunning how much more a trillion is than a billion.
Well, it's crazy when you compare a million to a billion, so let alone a billion to a trillion.
Nobody really thinks about it. I think about it a lot because that's the whole driver of my macro thesis. And so we've got 28 trillion, I think, resetting over the next 4 years, coming maturity. All of that, I think the average rate on it is less than 2%. So it's all going to reset at more than double. We're already spending 1.2, 1.3 trillion in interest expense alone. To frame that, our entire defense, which is by far the largest of the next, I think it's more, we spend more on defense than I think the next 10 countries combined. And we spend less than $1 trillion in defense. And we're spending over that amount on just supporting our interest expense. It's not sustainable at all. I've talked about this a lot, but I used to say there are 4 things that they could do. They're really 5, I guess. I had contemplated the 5th one. They could raise taxes, can't solve the problem mathematically. They could not tax us enough. It wouldn't solve the current year's deficit. So much less the aggregated debt. They cut expense, kind of hopeful about that under Doge, but
didn't do as much as it looked.
Didn't play out. And honestly, they can't really solve the mathematical problem unless they hit entitlements in Social Security, Medicare, and that's very politically untenable. And so doubt that will happen. If they don't ever touch those 2, they can't solve the debt problem. And a lot of people don't know this, but when they started Social Security, the age at which you could start receiving it was post life expectancy. And so I can't remember the exact numbers, but like at the time, life expectancy was maybe 60. And so it started paying out at 65. And so very few people actually were getting it. But, with the way we've advanced in medicine and everything, life expectancy is much higher. And I think they've raised it a couple times a little bit, but it should be materially raised. And ever since I was in my 20s, I never expected to get Social Security because that's how big of a geek I was studying things. But yeah, and the other things you could default explicitly. Greece does every few years or something, but
Is that the
makes it
fifth
really
one
hard
that
to,
you said you didn't think about? Was it just
no,
default?
default or inflate. Inflate's number 4, and so to me, it's totally obvious that the game at hand is to have high but sustained inflation, but don't report it on CPI. And so CPI calculation has been changed a couple dozen times over the years, and it always results in a lower number. That's weird, right? If they were just truly trying to measure things better, it would have at least one occurrence of it going up when they change the measurement. But that's not happening. And so they really want it, I think, where they need it to be is like 8-9% inflation. Because once it gets into the 20s or 30s, like I think a few years ago we were, when CPI printed 9, a third of the CPI is owner's equivalent rent, which is a Frankenstein number. And most of the stuff I was looking at had doubled in price. And they were saying there was a 2 to 3% increase in owner's equivalent rent through that period of time. That's just not true. It's disingenuous. And so, so even at the 9, it was massively understated. Everything I was buying was going up 20, 30%. And I think that they can't have it at that level because people really notice. But the single digits, people don't really pay attention to because it's not going as fast. We'll see. But I think, that's the game I'm betting on. But the fifth thing, David, was unfortunately the path that the current head of Treasury has said that they're on, and that is to grow faster than the debt is growing. Mathematically, that would work. That would solve the problem over time. It would reduce our debt to GDP, make the debt more serviceable, all those things. The problem is we would need the debt's growing at over 10% per year. So we would need GDP growth of over 10% per year for decades. We've only done it 2 times in history for 1 year. And so, and that was coming out of World War II and coming out of COVID. And so you had this massive spike in growth. And that's just,
It's not sustainable.
if it's never been done before, I'm going to probably bet against it. So I don't think they'll achieve their goal. They might be able to delay things a little, but the question originally was about rates. So I think if the market set rates, would you lend to the U.S. government for 4% for 30 years? No way. And because it's going to be worth less when you get it back. And it's not that they'll default, but inflation is going to be higher than that. And so your real return is negative. So I wouldn't do it. And the market was saying, you know what, we're not liking your financial decisions. And that's why the treasuries went up. The one question, though, in my mind, and I think they still have the firepower to do it, but that's not clearly the new guy will cut rates. A lot of people viewed him as a hawk. I think the market's read it wrong. Both Bessa and, who's the new Fed guy that they've said's coming in, blanking on his name. Anyway, they both worked for Stanley Druckenmiller. You guys may not know because you're not finance geeks, but Stanley Druckenmiller is one of the best investors in the world. He was involved with Soros when they almost bankrupted the Bank of England. So these guys know what they're doing. But when the markets read the guy as a hawk and said, "Oh, he's because he cares about how big the balance sheet is for the government," and by balance sheet we mean debt. How much the debt they had to buy them of their own, and Druckenmiller came out and said, "No, you guys are reading wrong. He doesn't want to cut rates because he thinks that the way out is to force growth too, and he wants to low regulatory environment, lower interest rates, et cetera." So I think he wants it. We'll cut. That is only the Fed funds rate, to your point, David. That doesn't affect what the treasuries are. But Besant has said if they don't get rates down doing that they'll step in and buy. And so if you buy a bond, it forces the price up and forces the yield down. I think there's a decent probability that they do that. They're already doing quantitative easing again, started in January. So they're literally printing money to pay for maturing debt. That's highly inflationary. So I think that's kind of where we are, sadly.
Well, that's a good doom and gloom to
Sorry.
end on.
Well, They're positive things to do, though. Like
buy
own real
apartments.
estate, buy apartments. I've joked with
Cool.
people a bunch of times. I really don't like the social impact of what I see forthcoming at all, but I can't prevent it, and so I just want to position for it.
Yeah.
Position accordingly, as I say. And I'd rather own the castle than be the serf.
That's a great quote.
Well, I can't tell. Thank you. No, I learned a ton, and I'm going to be googling some things and getting some books after this. So I appreciate it, Bruce. Can't thank
Well,
you enough for your time.
Yeah.
glad it was
And
of value.
where can people find you? I know the LinkedIn, you
Yeah,
post stuff on there.
connect, DM me or connect with me on LinkedIn. I accept most people unless it's
Looks fake.
someone I can tell is going to talk to me about SREO or, I mean, not SREO, digital marketing and that stuff, So, but I've got some really interesting people that I'm connected to. I've got some people on sovereign wealth funds. I've got board member of Freddie Mac that have reached out and connected. So connect there, because then you can see the content of what I put out, kind of what we're thinking and why. It's not very often. I'm never going to post a deal or never post what I'm having for breakfast or me in front of a private jet that's not mine. It's just about kind of where I see things going, and hopefully, so you guys don't have to read all the ugly stuff I do, filter it down. Like CPI, I mean, I don't need to get off track here, and I will answer the question explicitly, David, in a second. But you look at the things that we're improving with CPI, and a smaller CPI doesn't mean that inflation, the prices have gone down. It just means that it's growing more slowly than it was. It's not deflation; it's disinflation, which means, if 100 went to 110. Well, it's still stacking on top of 110. It's not going to 109, 108. But even the way we were getting the disinflation or the reduction in the rate of increase was coming from, guess where? Crude oil. Crude oil and used cars, technically, were the only ones that had gone down. But you think crude oil is going to print lower now? I don't think so. Not until they get that Strait reopened. And so I think there's going to be the win in the sales for inflation for a while, until they get that situation better under control. Now, it could resolve rapidly. It could Venezuela the place where they just step in but it doesn't look like the current leadership, the clerics, are wanting that. They're still trying to vote their own people in. But I would be surprised if, after doing all of this, that we let that happen. So we'll see. We'll see how it goes. And so connect with me on LinkedIn, just Bruce Fraser, F-R-8-S-E-R. We don't have a company site. It's just me personally. Or, go to our website, elkhornpartners.com. You can request information there or see what we're doing there as well.
Bruce, you got a new LinkedIn invite in your ebox.
Okay, great. As long as you don't try to digitally spam me, I'll accept it.
I make no promises.
I mean, it just kills me. All these people contact me. Let me show you how to scale. I'm like, show me your balance sheet, and then we'll talk. If yours is bigger than mine, then I'll get some pointers from you.
Well, thank you again. We appreciate it.
All right. Thanks, guys. It's good talking.